All right, guys, this is Fayaz Desaji. Just want to welcome you to our live stream today that we've got going on. Today, our topic is really we're going to discuss the real estate market in general, and then we're going to dig in a little bit more into the real estate market in the greater Charlotte area. I'm joined today by two industry experts. We've got Mike Pennington with RMS Mortgage. Raise your hand, Mike.
Hey.
Mike has been in the industry for many years, has gone through the ups and downs, so he brings a wealth of experience. He's based in Charlotte, and we'll get a little bit more into his business. And obviously, we've got my business partner as well, Mike Morrell. Mike has been in the business for quite a bit as well, gone through a recession. So we've got two people here who have seen a previous recession, and I'm going to talk about what potentially are the expectations, what are they experiencing right now, and how can you best plan as whether you're a buyer, seller, or an investor in today's market. So Mike, talk a little bit, Mike Morrell, talk a little bit about your history, how you got involved in real estate, and kind of like your experience in these kinds of markets of the past recession.
Sure. Yeah, I got into the real estate market in 2007, at the end of 2007. So then when the market tanked in September of 2008, I was new to the business. On the day that the stock market crashed on September 29th of 08, I think it was. At the time, I was in new home sales and had 11 homes under contract. And that week, 8 of those terminated. 8 of those ended up being investor buyers that were planning on flipping in that market. So that all went away down in Tampa, Florida, where I was living at the time. Not long after that, the company that I was with offered me a transfer up to Charlotte, North Carolina, because here the area was not as impacted like places like Tampa or Phoenix or Dallas or Vegas, any other places that really got clobbered last time the real estate market and the stock market crashed. So that's when I moved up here, just because things in general in Charlotte just weren't impacted as much. Homes kept selling.
Right. Awesome. And just some, if anyone who is watching, whether you're watching on Facebook Live or if you've joined us on the Zoom call as well, if you have any questions that you'd like to ask the panel, please feel free to type it in the comment section below. This is an open forum, so we want to make sure that we use this opportunity to answer any outstanding questions that you might have. Mike Pennington, talk about, again, where you're coming from, your past experience, and then we'll dig a little bit more into that.
Absolutely. So thanks again for having me. I got into mortgages the end of 2003. I had gotten out of the Marine Corps and had some buddies that worked at Countrywide. So I've had some experiences with some turmoil in the industry. That was also where all great Mikes come from, out of Florida as well. I was in Orlando at the time. And we had bought a house and sold it and couldn't find anything there that was priced well. So we moved up to Charlotte. Going on 15 years ago now. And so in 2008, 2009, there was a lot of impacts to mortgages, lots of foreclosures, lots of my parents and family all in Florida greatly impacted, where home values, drastically dropped. And so been up here ever since. The market's doing well. Charlotte's a great marketplace. There's lots of real estate that's available at a price point that's well for people. But I got in 2003, been doing it every day since.
Gotcha. So right now, what's making, in your opinion, what makes this market or maybe this scenario a little bit different than what you've experienced before?
So in the mortgage market, it's impacted differently from a standpoint of banks were going under in the bubble. People were going into foreclosure during the bubble. One of the best things that has been implemented now is the kind of, I don't want to say forced forbearance option for homeowners, but this week we touched 30 million unemployed, and none of those people can legally be foreclosed on. And so that's a huge opportunity. That's a big difference, is that there's been a lot of, instead of blaming big banks and investors, I mean, we were doing, back in the day, you could get one day out of bankruptcy with a 500 credit score, you could get a loan. And so a lot of those programs have gone away, and there's not as much anger as the big banks failing now, and the investor appetite for those things has really tightened up over the past 10 years. So we really don't have the risk opportunities that were there back in 08, 09.
Okay, gotcha. So that's from the mortgage perspective. Mike, what about you? Again, you've gone through something like this, or maybe something a little bit different. What's different in your mind right now?
Yeah, I think the biggest change right now is the fundamentals of our economy. We're all strong when this hit. You know, we're being hit with a global pandemic right now that's affecting everybody in the entire world. So whereas before the biggest challenge, I think, was money was flowing a little bit too freely. Places like Mike and Countrywide were giving people like me a loan for a second home with just a social security number.
Right.
Whereas now I think that lenders had tightened up. I think that they're being more stringent with their lending a few months ago. And the biggest change has just been the virus hitting us has affected everybody, has hit the stock market and just shut down the economy. But the expectation is that once things loosen up again, once we have some treatments for the virus, I think that things will begin to open back up. There'll be some pent up demand.
Gotcha. Okay, so let's talk a little bit more. There's actually a question that was just presented to us on one of our on our chats here. Do you think you'll see foreclosures as a result of the current market right now?
Go ahead, Mike.
All right, I was going to say from my perspective, I do think that you'll have some, but with some of the guidelines that have been placed by the federal government on what banks can do, the allowing the forbearance, there is actually a law out there where the banks cannot foreclose. Nobody can be foreclosed on. If somebody even was behind in January and February and December before all of this hit, those people technically right now, legally, not technically, legally cannot be foreclosed on. Now, when we come out of this and we see some of the forbearance impacts on homeowners, or I believe everyone understands that of the 30 million people that are unemployed, not all of them are going to be able to come back and secure jobs. And that's really where it will be. It will be down the road. It could be 6 months from now. It could be 18 months from now. But from a lending perspective, yes, there's great requirements now to make sure that people have jobs. We used to have to verify employment 10 days before closing. Now we have to do it within 24 hours of closing. So you're starting to see some of those things to come into place to help alleviate, hopefully, some new home buyers from going into foreclosure.
Okay, gotcha.
Right.
And Mike, what about your thoughts?
Yeah, just to tag on to that, these people who are getting forbearances now, so if they have a $1,500 mortgage payment, for example, and they get a forbearance and they don't pay that mortgage payment for 3 months, at the end of that, $4,500 is due. And if you've been on unemployment or don't have a job, like where are you going to come up with that $4,500? So
Right.
I expect that we're going to see more modifications. I expect that down the road, we're going to see more foreclosures just for those people who are impacted by this directly.
Got it. Okay. And Mike Pennington, you mentioned a term that has been in the news a lot, but a lot of people still don't understand forbearance. Talk about that. What exactly is it? What are the pros and cons of it?
Yeah, so there are several pros if you need it, and even pros if you don't need it. If it is dependent upon your servicer of your mortgage directly. The easiest thing to do, and I have found people, and I don't want to put any, I'm not going to throw any big banks under the bus here. There is a specific large big bank that is offering it to people, and if they're not accepting it, they're automatically putting them into a 3-month forbearance. So if you call in and you apply, they say, yep, you're approved, and they automatically put you into the forbearance, even without asking. But so the risks of going into a forbearance is, one, you cannot refinance. If you're in a forbearance, you cannot refinance. And technically right now, there's no guidelines that if you're in forbearance for 3 months, in December, if you're even allowed to refinance. There's no guidelines on that right now. Because in order to get a refinance, you have to have 12 on-time mortgage payment history. Well, if you go into forbearance, you don't make those payments. So that's a huge risk that there's no answer to right now. Nobody knows that. But the individual investors are making the choices. Some investors are doing it for Fannie Mae and Freddie Mac invested loans directly. I know that another big bank here in Charlotte that is doing it for all loans, whether they're Fannie or Freddie direct. They're doing it for everybody, but I would call them. I would find out what the guidelines are. Some are allowing you to modify the note. So if you go into forbearance for 3 months, they're letting you extend your loan out for 3 months, so that at the end of the 3 months, you don't pay $4,500 in Mike's example. But a lot of them are requiring full payment at the end of that forbearance period. And so a $6,000 mortgage payment in 4 months would be a pretty hard pill to swallow. And so there will have to be some modifications to the guidelines, and it's all really a gray area right now. But the only people that can tell you the guidelines or the rules around it is your current servicer.
Gotcha. Okay. Well, we just had another follow-up question to that, Mike Pennington. If you borrow money to buy a house, are they limiting your ability to request a forbearance prior to receiving the loan?
So I'm going to, and this is going to be a little in the weeds, but I'll try to keep it out. So so I'm a mortgage company. If you come to me, I'm a lender. I don't service your loan. Your loan was going to be sold directly to Fannie Mae or Freddie Mac. Well, Fannie Mae and Freddie Mac, when they get these loans, they require that a payment has been made. Some of them are requiring up to 4 months of being paid. And so if you come to me today and you buy a home and you close today and you call in for forbearance, my company is on the hook for making 4 months of your mortgage payments while in forbearance. Now, you'll be subject to making the 4 months when you come out of forbearance, but the individual mortgage companies right now are on the hook. I will say Quicken's name because they're a big bank. Quicken, the last article I read on them was if they don't get some relief on this, $100 billion a month if people call in. There was a 8.6% of people have gone into forbearance on mortgages in the last 30 days. So people that normally that rate had run around 2%, and it's up to 8.6 in forbearance. So the individual investors, the lenders, are still responsible for making that payment, even if you don't make the payment. And that's why going into home buying, lenders such as us are required to verify that you have at least 1 month of assets, make sure that you currently have a job and actively employed, to kind of defer that forbearance process. It's not something that any lender wants you to do in the first 3 months of your new mortgage.
Gotcha. Okay, perfect. Do you see rates right now? I mean, how are they compared to what was going on prior to this whole coronavirus situation? And what's the Fed was just announcing the other day. What are you seeing, Pennington, regarding the rates for the next month or two at least?
Yeah, so long-term rates are going to be held low. This is a short-term. So for us as individuals, we feel like this is hitting us hard now because we're stuck in our homes. We can't go to work. We can't do these things. But the long-term impact on the economy is going to be, it's unfathomable, the amount of damage that's being done right now to several industries that are out there. And so we'll see that long-term hit to them that will slow the growth, which will force us to keep interest rates low as a industry. And the government's doing a great job of keeping them low. They actually just introduced, again, not too weedy, normal mortgage rates. The lowest that we've had is a 2.5% mortgage-backed security coupon. For the first time ever in history, they've introduced a 2% coupon. Now that leads to a belief that rates will go lower, and not significantly lower. You're probably talking somewhere around 2.75 to 3% on 30-year fixed-rate mortgages, which is really where we are now. But if we don't see some really strong growth, we could see them push a little bit lower.
Okay, so let's pull back a little bit, Mike. From a real estate agent perspective, you're helping clients buy and sell homes daily, right? What are you seeing right now with the process? Any slowdowns? And also, Mike Pennington, after Mike answers, are there any delays right now? Geronda was asking, are there any delays right now from the mortgage and funding standpoint that both clients and agents should be aware of?
Sure. So the delays that we're seeing in the real estate side in the process are just because of the lending side, right? So it's taking a little bit longer to get an appraiser out there. It's taking a little bit longer to go through the mortgage approval process. But I don't think we're seeing any slowdown in the contract to close process in real estate.
Okay, gotcha. And Mike Pennington, what
about? From our standpoint, I tell people this even before the pandemic. I need 5 days to get your loan closed. Everything else is everybody else's delay, meaning title, you getting me documents, the appraiser. I am seeing maybe an added day or two to appraisals, but this month in April, we got 3 deals from other lenders that had turned them down or weren't able to get it done quick enough that we closed in 2 weeks. And that was with ordering a new appraisal. So not seeing really a lot of slowdown there unless we have to start leaning on the government, whether that's for getting a title issue cleared up with the courthouse and nobody's working at the courthouse, or making sure that an encroachment on a property, we have to get a survey. So some of those things, you're starting to see some delays, but from an actual lending standpoint, the process is really, really still smooth.
Gotcha. Okay. Geronda, hopefully that answers your questions. What are you guys seeing right now? I mean, we're currently almost in May. We've now been in, depending on which state or which country you're in, about 6-7 months into the whole coronavirus situation. Mike, what are you seeing with your market in the Carolinas? And Pennington, what are you seing on your side as well?
Yes, I can tell you Carolina's dream team. Last year in 2019, we sold an average of 12 homes per month. In the last 30 days with COVID-19, coronavirus, all that stuff going on, we've sold 23. So our business has actually doubled from now to last year this time. I think that we were already in a pretty strong seller's market, the strongest seller's market in recent history. And that has tightened up even more right now. A lot of people have decided not to list their homes right away, but there's still a ton of buyers out there. So we've actually seen the inventory go down 22% in the last month. So it's been significant. It's become an even stronger seller's market right now.
Gotcha. All right, Mike, what about you?
Yeah, so twofold, yes, purchases are on the rise. I think, like I said, I think we have 14 people on the buy side that are closing in May, 14 buyers in May, that we probably run around 10 to 12. So we're up there as well. The biggest thing for me is refinances. I'm on pace to double last year just because of refinances with rates as low as they are. We are seeing, I did the math. I think that by the end of May, I will have closed the last 2 years worth of refinances. So it's been incredibly busy from a refinance standpoint. But of course, from the buy side, people are buying homes. I think we have 27 pre-approval letters out. Normally we rock with about 10 to 15 out. So people are looking for homes. The buyers are there. I think as your entire team would say, is that you're ready for the market, for the sellers to get out there and get them on, because the buyers are lining up.
So is it harder right now for buyers to buy a house? I mean, you mentioned earlier the Fed is tightening up some guidelines, or how do they get around it? For example, one of the questions that we have right now is, are adjustable rates now potentially a better option for some people than they might have been even just a couple months ago?
So unless you go to a direct, like a credit union, somebody that's going to hold and service a loan, no. Adjustable rate mortgages are higher than 30-year fixed rate mortgages right now. 15-year fixed mortgages are higher than 30-year fixed mortgages. And to try to quickly explain that, remember when I said that the investors were going to have to, or the lenders are going to have to make the payment on behalf of the buyers if they go into forbearance? Well, a 15-year payment is higher than a 30-year term payment. So rather, what they're doing is you're starting to see investors keep the 15-year rates higher, or at least the same as a 30-year fixed rate, to defer people from getting into those 15-year term payments in case they do go into forbearance and they're stuck making those payments on their behalf. But an adjustable rate mortgage, there's really not an appetite on the secondary market for them. And when you can borrow, so think of it this way, a bank always has a margin, okay? And margin's usually 2.25 to 2.75. Well, if they're lending at 3% and their ARM margins is 2.5 to 2. There's no, they don't have the ability to offer you a reduced interest rate. The lowest they could offer you is 2.25, 2.5, 2.75. Well, you can get a fixed rate mortgage for pretty close to that. So
Gotcha.
there's really been a slowback on that.
Awesome.
If I can take a shot at that from more of a layman's perspective, I think that adjustable rate mortgages are really interesting when rates are higher. If right now rates are at all-time lows, the only place they have to adjust is up. So,
yeah, absolutely. All right. See, Pennington, much simpler. That's the difference between a real estate agent and a lender.
I'm dumber. That's the difference.
We're here for all of our for all those people out there in the ether. We're here to interpret the complications that a lender presents for you. Mike, you mentioned that right now you're double what in terms of clients what you were doing last year on average. Mm-hmm. So what are you doing? What are you having to do different to serve your buyers differently? And also your sellers? What's the pivot shift been for you guys?
Yeah, so we were already doing some of this, but we've just really had to embrace technology. You know, we sold a home last week. It was a home in the Ballantyne area of Charlotte that I've actually never seen. I've never been in the home, and I'm the listing agent. So we were able to do a virtual 3D tour where a buyer can go and walk through the entire home as if they were there in person and see all the nooks and crannies and see how the rooms connect, without having seen the home. So we listed that home. We got 3 offers and sold it in one day without anybody having stepped foot in the home. So I think with just embracing the greater technology and doing things like photos and virtual tours and drone tours, I think that we're working around the circumstances that we're in and finding ways to still sell homes, and buyers are embracing it.
Gotcha. What about you, Mike? What are you doing differently? Just very briefly, since you're saying you're having more business now.
Yeah, we're not really having to do a lot from the process standpoint. It's really just some of the delays with getting an appraiser out there. But again, most refinances aren't requiring an appraisal, so it's been pretty seamless transition for us outside from a process standpoint.
Gotcha. Okay. Here's a great question. Is Charlotte and the greater Carolinas region, is it recession proof? Mike?
So I don't know that anything is recession proof. When I was in Tampa in 2007, there was all this talk, things had been going up and up and up. We'd been in the longest bear market of a long time. And they were saying that Tampa was recession proof. They're saying that so many people were moving to the area that it would just keep maintaining. Same with Orlando, where Mike was, until it wasn't. And during that time, like I mentioned, I moved to Charlotte at the time because it's a much more stable market. They offered me a transfer up here because it's not as strong as an investor market. In a lot of areas of the country, there's a lot more speculative buying where the prices just increase so quickly in a good market that you can buy a home and flip it, like a new construction home, for example. You could go under contract in a home and flip it before the home closed and make money.
Right.
You can't really do that in Charlotte. Prices just don't go up as fast.
Right.
And the other side of that coin is that prices don't go down as fast as some other areas of the country when bad things happen. Okay. So I'd say we're definitely a lot closer to recession proof than most of the country. It's a great place to be, but no is the answer. We're not entirely recession proof.
Right. And Mike, you also came from Florida on the mortgage side. I mean, what's the historical trends that you've seen in this area versus some of the others? I've been talking to some of my counterparts in New York and in LA, down in Florida, and they're really feeling the impact of this right now. Are we cocooned a little bit more?
With Mike, I'll say the same thing. Like, that's part of the reason why we moved up here was because the impact of of what the market had done. House prices didn't jump as much. We had bought a house in Florida for $140,000, and 2 years later sold it for $225 during that whole bubble time, and we couldn't find anything down there for less than $400,000. So my wife and I bought up here for $180,000, and at the lowest price in Charlotte after that drop, it dropped to like a home value of about $165,000, whereas the home that we had sold for $225,000 on Zillow, it had dropped to like $105,000.
Right.
And so that's one of the reasons. Part of that is that there's a lot of, I don't want to say money in Charlotte, but there's a lot of business professionals in Charlotte, and business professionals generally have a more stable work environment which allows them to, in this environment, to be able to continue to work from home and do their job.
All right. Well, you just really allowing me to transition well. Let's talk about the elephant in the room. There's 26 million Americans who are currently unemployed. Over the course of the last 4 weeks, we've seen some drop-offs in unemployment. However, it's still much higher than we're used to over the course of the last couple of years, right? I think, if I'm not mistaken, the unemployment rate is around 9 or 10%, if not more, nationally. How is this going to impact the housing market? Let's just get down to the nitty-gritty. Mike Morrell.
Yeah, so I think that, again, keeping it simple, if there are people that don't have jobs, they're not going to be able to qualify for a mortgage.
Right.
We're definitely going to be impacted that if they're tightening lending standards and people with lower credit scores can't get approved for a mortgage, then we're going to see some of those first-time home buyers drop out for a little while.
Right.
So we're going to feel it. Right.
Okay. Mike Pennington, what about that? What about you?
So I'm going to ask you to repeat the question because I was getting two answers that for the question. So
okay. So the unemployment rate, I think there's 26 million Americans who are unemployed. It's potentially going to increase. We are most likely going to see double-digit unemployment rates in the United States on a national level. How's it going to impact Charlotte? What are you guys going to? What do you think will impact the housing market? Are we going to see price decreases, values?
So and the answers I was getting, actually 3.8 came out this morning. So we're up to 30 million unemployed. The actual unemployment percentage right now is forecasted to be 14%. That'll come out next Friday, will be the actual percentage. Quick math, though, is that labor force is about 165 million people. If we have 30 million in claims, that's an 18% unemployment. But next week, they're expecting that number to come out somewhere around 14%. So the way that employment works for getting qualified is we have to have a 2-year employment history. If you've been unemployed during that time period, we can count the unemployed gap as part of that 2-year history. Where it will become difficult is if you don't have 2 years of employment history. Say you're 19 years old, you just graduated high school, and you've gotten a job, and you want to go out, you and your girlfriend want to buy a house, and now you get laid off. There isn't a 2-year history. That 2 years will have to start all over again. And so the really young buyers, fresh out of college, that haven't had a 2-year employment history, that's really where we'll feel some of that impact on first-time home buyers. Okay,
so the millennial group could be feeling this a little bit more. What about other demographics, the seniors, or what do you think about that?
Yeah, so I know that
from a mortgage standpoint, I was going to say, that's a Mike. Yeah, I was going to say from a mortgage standpoint, nothing. That's a Mike question for sure.
Yeah, so I was just looking at some data this morning, and year over year, if we look at March of 2020 compared to March of 2019, what is called the silent generation is the oldest buyers that we have in the market right now are down 26% in mortgage applications, March this year compared to March last year. Wow. Baby boomers are down 22% this year to last year. Interesting thing is millennials are only down 2%. Our buyers that are in the market right now that are most active are the millennials. That's who's out there buying right now during this COVID-19 stuff.
Okay, awesome. Well, I actually closed today.
If I can hit on the pricing thing real quick. I think a lot of what we're dealing with is the month's supply of homes for sale, the whole buyer's market, seller's market thing. And for those of you that don't know, equilibrium is 6 months. And what that means is if we take all the homes that are on the market right now and continue selling at the current pace, in 6 months, there will be no more homes on the market. In 2010, when all that stuff came through, the Charlotte market was at 13.4. So it was a very, very, very strong buyer's market. Right now, we're at the lowest in historical data that we have. We're at 1.9 months. So if no more homes come on the market, we will be out of all the homes for sale in just under 2 months. So I think we're seeing, go ahead.
Yeah, so am I correct in saying that people are a little bit more hesitant to sell their houses, but yet there's a lot of buyers out there looking? Is that what the data tells me?
Absolutely, and I think that's what's holding up prices for us right now. For our
Okay.
sellers that are going on the market now compared to last year, they're selling for more money. We haven't seen pricing be impacted in this market yet by the COVID-19. And I think the reason for that is because there are so few homes for sale. If I were selling my home right now is when I'd be selling it, because there are tons of buyers out there. There's nothing for sale, and interest rates are still at historical lows.
Gotcha. Awesome. Thank you for summarizing that. Mike, you talked, a couple questions ago about interest rates being low. What's the difference in payment right now for, one of those buyers right now for interest rates, let's say on a $200,000 or $250,000 house versus what they were seeing even a couple months ago on a monthly basis?
So it's about $16 for every 1/8%. Every 1/8% costs $8 for every $100,000 financed. So in February, interest rates were about 3.75%, and now they're around 3%. So that is 6/8 difference in pricing. And so if you take that times $200,000, it's about $90 a month payment difference on a $200,000 home. On a $400,000 home, you're talking almost $200 a month payment difference for the exact same home.
Okay, so
You
definitely
mid-February to now.
affordable, obviously.
Yeah.
Gotcha. Okay. I want to give you guys a chance to, if there's any other questions, let's see what we've got here. We talked about there's no delays right now. Any projections that you'd like to put out there at all of what you, based on your experience? Mike Pennington.
I would project, which I don't do, I would tell you that you're safe to bet that if you're going to buy, now's the time to buy. I do think that we will see interest rates held down for a while. It could change tomorrow. I will tell you that if they come out with a vaccine tomorrow, we will see a run on interest rates immediately. Nobody thinks that that's going to happen, but I would tell you that long term, at least through election period, at least through November 2nd or whatever day it is this year, that we're going to see interest rates held low. Because it's going to be the only thing that's going to keep the housing market as strong as what it is by helping keep interest rates low. Gotcha.
Mike, anything you'd like to add to that?
Just that I think that people need to know that it's still a great time to be buying and selling homes. With all the extra precautions that we're taking, where we're going and showing homes. For example, if I take a buyer through a home, I'm the one touching the doorknobs. I'm wearing a mask. I'm wearing gloves. We're wearing booties. We're using hand sanitizer before going in and going out, and we're doing our very best not to touch anything. So we're taking whatever precautions we could possibly take. And as a seller, it's important that you know that there are still tons of buyers and that pricing hasn't really been impacted. As a buyer, it's important to know that interest rates are still at all-time lows, and it's still a great time to buy.
Absolutely. Yeah, this is, I love that you talked about that, Mike, because, this is an opportunity and people need to know that they're safe, both on the buyer side and the seller side, right? And that there are professionals out there who are taking the measures to protect their clients. So it's really important to align yourself with that. Well, we're kind of getting to the end of our webinar here. I do want to put in some shameless plugs out there. If you have any further questions on the mortgage side, make sure that you contact Mike Pennington at RMS Mortgage. His cell phone is 704-840-4146. You can also go on their website, which is closingthecarolinas.com. Or if you want to find him on Facebook, it's Ask Mortgage Mike. And then if you have any real estate related questions, if you're an interested buyer or seller, or even an investor currently in the market, feel free to reach out to Carolina's Dream Team. Our line is 704-802-9998. You can always find us on Facebook. Just look up Carolina's Dream Team. We're a full service real estate team. Thank you again for joining us, guys. We appreciate the time and the knowledge that you've imparted on our audience. And we're looking forward to doing this again. Everyone have a great day. Stay safe and let's continue to move forward. Have a great day, everyone.
Excellent. Thanks, guys.
All right, guys, take care. Thank you.